Hey, YouTube family, and welcome to another edition of the Kevin Strong Show. And in this video, we're going to talk about the banks and inflation. They both are set up as a legal means to steal your money. We're going to talk about how banks have been closing their branches since the virus kicked off in March of 2020. We're going to talk a little bit about the FDIC, which is supposed to insure your money if you have $250,000 in a financial institution that's backed by the FDIC. And that's not really the case. The devil's always in the details. And finally, we're going to wrap up with inflation. So if you're enjoying this type of content, I'd like to ask you to subscribe to my channel. Please comment and share because I care. And without further ado, let's go ahead and get into this. Very excited about this topic, especially when I get to the FDIC. So please stick around for that portion of this video because I guarantee you no one has broken it down like this. If they have, very few know about it. So please pay attention. Really, really good information. I want to come out and give you guys practical content and not just come off just talking about various topics. So we're going to start off by talking about how branches have closed within the last couple of years. In my humble opinion, this has been a systematic setup to restrict the average consumer from accessing their cash. So this report comes out from the National Community Reinvestment Coalition. They came out with an article this year talking about branches that have been closing. So 9% of all branches in the United States closed between 2017 and 2021. So in a 4-year period, 9% of all branches have closed. A loss of about 7,500 brick and mortar locations. The branch closure rate, right? The rate at which these banks are closing or branches are closing doubled during the health crisis. Banks have closed more than 4,000 branches since March of 2020. This doubled the rate of closures from 99 per month during 10 years prior to the pandemic to averaging 201 closes per month. And if you've noticed, when you go into a financial institution, there isn't that many tellers. If you try to take out a decent amount of money, it's not necessarily available. Sometimes you either have to set up an appointment or the branch manager will tell you you have to come back in a couple of days or in several weeks. So clearly the banks do not have cash on hand. Also, when it comes to branch closings, low to moderate income and minority neighborhoods were hit hard. I'm not going to go there. You can draw your own conclusion, but if you're thinking like I'm thinking, it's true, homie. 1/3 of branches closed from 2017 to 2021 were in low to moderate income and or a majority minority neighborhood where access to branches is critical to ending inequality and in access to financial services. This especially hits hard for the elderly because they don't necessarily keep up with technology. They may feel more comfortable handling their banking transactions in person. They may not be just comfortable with everything being online and being electronic. So it's just a hot mess. It's really, really getting worse. We're going to talk about actually a bank run. So before I get into talking about what a bank run is, just so you guys understand, there's only about $1.7 trillion physical dollars that are circulating throughout the whole system, financial system, not only in the United States, but in the world. So in theory, if everyone was to go to their prospective financial institutions and say, hey, I've got $5,000 in the bank and I want that $5,000 back, only about 8% of the people who have those digital, that digital money in your screen can actually translate that or convert that to hard physical dollars. So 92% of the money does not exist. You can only get 8% of it. That's why I've been talking about keeping money out of the banking system for years. Ironically, at the very minimum, if you're able to do so, at least have 30 days to cover your expenses. So we're going to talk about a bank run. So basically what a bank run is that you get this feeling in society that the banks are insolvent and you don't think they have the money. So everybody rushes at the same time to get the money out of the bank. And as a result, as I just indicated earlier, they don't have that money on hand. They used to be required to keep a certain percentage of money in the bank in relationship to the amount of money that they lend out. They call that fractional reserves. They have done away with that. The banks are not required to keep any capital on hand. So when you get to a point where people don't think that banks are strong or they're becoming insolvent, they all rush to the financial institutions, and what? They don't have enough. So ironically, the first bank run, I think, was around 1930 in Nashville, Tennessee, which is about 2 hours east of Memphis. And that was the beginning of a bank run. So it happened in 1930, and then it happened like in 1931 and in 1932. Ironically, what also was happening during that period in history, we were experiencing the Great Depression. So I think around 1933 is when the Banking Act came into play to basically try to stabilize the financial system, because these banks have been experiencing a run for almost 3 years prior to this act going into in existence. And it came up with the FDIC, the Federal Deposit Insurance Corporation. And this was supposed to be set up to tell folks, hey, don't worry about it. In the event that you have $250,000 or below in a financial institution, the government's going to back that money up. So in the event that a bank becomes insolvent, the government's going to step in and make you whole. And that part and parcel did instill some financial confidence among people during the Great Recession. So before I get into the inflation component of this, I'm going to read some stuff here about this financial Federal Deposit of Insurance Corporation, FDIC, because most people think when you see that emblem on your financial institution, you think you're all good in the hood. That ain't true, homie. So I've just explained to you what a bank run is. A bailout is what happened in 2008. So back in 2008, the financial system was basically getting ready to collapse. Our fiat currency dollar, which is basically what it is, the dollar bill is a fiat currency, was basically supposed to come to an end. The government stepped in and did quantitative easing. Out of that, there was something called some Dodd-Frank legislation that came in to make sure that in the event that banks became insolvent again, that the taxpayers wouldn't have to bail them out like they did or like we did in 2008. A bail-in, stick with me now, a bail-in is when a bank becomes insolvent and the money that's on the books, your money gets flipped over as a liability. So you become, and I'm gonna get into this FDIC stuff. Every time you make a deposit into a financial institution, that money isn't yours. It becomes a liability to the bank. And then the bank has to satisfy that liability when you request a withdrawal. If they don't have the money, guess what, homie? You're out of luck, right? And that's why you're starting to see systematically over the last couple of years, branches are closing. You have to set up appointments to talk to a manager. And God forbid, if you want to take a decent amount of money out of the bank that you think is your money, they might not necessarily have it. Once again, that is the practical aspect of what I've said in terms of feeling like a creditor and your liability to the bank. Because in theory, if you've got $10,000 in a bank, you should be able to walk in there and get all of your money. Go ahead and try that and see how that works out. So now we're going to talk about the FDIC, okay? And I told you about Dodd-Frank was probably one of the main impetus that basically created the FDIC and they got it going. So here, clearly states, and this is the Dodd-Frank Act, clearly states the order of payment of bank creditors. The FDIC pays in the following order. So keep this in mind. If you have a financial institution and it becomes insolvent, it's broke. It's broke like a joke. So understand, this is not Domino's Pizza. You don't get the call and be like, hey, I understand ABC Bank is insolvent right now. I've got $80,000 in there. Just send my check to 123 Mockingbird Lane. 2 or 3 days, do I have to wait? Wait till you hear how long it might take you to get your money, if you get it at all. And yes, we're talking about FDIC, supposedly backed by the government. So here is the order. That in the event that a bank becomes insolvent, somebody won't leave me alone. In the event that the bank becomes insolvent, this is the order in which they pay out administrative cost, the government, wages, salaries, or commissions of employees, contributions to employee benefit plans, any other general or senior liability of the company. Senior liability of the company. Number 6, any junior obligation. 7, salaries of executives and directors of the company. And 8, here we go. You always save the best for last, right? Obligations to shareholders, members, general partners, and other equity holders. Other equity holders is you, homie. Number 7 and 8 are considered unsecured creditors and cannot be paid until all other claimants are paid first. So keep in mind, when a bank becomes insolvent, you've got 1, 2, 3, 4, 5, 6, 7, and then 8. You're last in line to get your money. Hold up, it gets better. Also, the Dodd-Frank Act allows between 3 and 5 years for the FDIC to complete a liquidation. In a significant banking crisis event, it could be years before depositors get paid their money, if any money is left to pay at that time. So you see what I'm saying here, folks? This is why I've been on record for years talking about keeping money out of the banking system. It could take a long time, years, 3 to 5 years. And that's what the government's saying, right? It's probably a lot longer than that, or you're probably not going to get your money at all. But they can't come out and say that because that would invoke a financial panic. So inflation comes up and down. Yes, that does eat away at your money. That is a theft of your money. But the real scary part of what's basically looking at taking your money legally and maybe permanently is our current banking system. And that's why you've got this cryptocurrency stuff going on and all of these exchanges becoming insolvent. You've got pensions I've talked about earlier that involved in cryptocurrency. So this is all globally connected. Watch how many banks start to implode in 2023. Watch how many companies start to go bankrupt in 2023. It's in my humble opinion that you do need to keep some money in the banking system. You're better off dealing with a credit union than one of the big 3 or 4 top banks. That doesn't mean that in a credit union, this won't happen to you. You're just reducing the chances of it happening to you. And once again, please keep some money out of the banking system. And finally, if you haven't heard, there is talk about the Fed trying to roll out a digital dollar because they know we have a liquidity crisis forthcoming. So I hope you enjoyed this content. I'm going to end the video with my famous line, keep your credit score up and your debt down. Please smash that like button if you are enjoying this content and share the video with other people so they can subscribe as well. This was the Kevin Strong Show, and I'll see you guys in the next video.